Hey everyone, welcome back. Today we're going to deep dive into a topic that I think is on a lot of people's minds, right? Making that crypto work for you.
Yeah.
Specifically, we're going to be exploring different passive income strategies that involve crypto.
Right.
And let me tell you, this video we're looking at today is packed with some pretty wild claims.
Oh,
We're
yeah.
talking APYs of like 12,000%. You heard that right? 12,000?
Wow. That's pretty eye-catching for sure.
Right. So I think it's going to be a really fascinating deep dive, but maybe we should start by kind of like setting the stage.
Okay, sounds good.
The video dives into a lot of different approaches, but right off the bat, they highlight this idea of APY,
Mm-hmm.
annual percentage yield.
Yep.
But I'm guessing there's more to the story than just chasing the highest APY, right?
Yeah, absolutely.
Okay.
Yeah, I mean, you're right. These numbers can sound really impressive at first glance,
Uh,
but it's important to kind of look beyond the hype and understand what those returns actually mean in reality.
so let's get real then. What's the catch with APY?
Well, that's where this concept of real yield comes in.
Okay.
You see, a lot of times these really high APYs, they don't account for a really important factor, inflation.
Right.
Essentially, over time, inflation just kind of eats away at the purchasing power of what you're earning.
So even if I'm earning like a crazy high APY, if inflation is higher, am I actually losing money?
Yeah, unfortunately, that is the kind of the harsh reality of it.
Wow.
The real yield is what you earn on top of the inflation rate.
Okay.
It's the only yield that really accurately reflects how much your investment is truly growing.
Gotcha. So it's kind of like I'm earning something, but then it's a losing value at the same time. So
Right, exactly, yeah.
I'm not
It's just like a
actually.
treadmill.
Yeah.
You know, you're running, but
Yeah.
you're not actually going anywhere.
Yeah. So
For example, the video mentions staking Atom as one option.
uh,
And staking rewards says the average yield is around 17.91% APY.
okay, that sounds pretty good.
Yeah, it does, right?
But I have a feeling there's a but coming.
There is a but. Atom also has an inflation rate of about 12%. So when you actually factor that in, the real yield that you're actually looking at is closer to 6%.
Oh wow. Okay, so that's a big difference.
It is.
Yeah.
It's significantly less impressive than that initial 17.91%.
Right. It's a good marketing
Oh,
tactic.
yeah. Yeah.
Okay, so big takeaway here. Got to always look beyond just that flashy APY number
Yeah.
and focus on the real yield.
Yeah.
Got it. So speaking of staking, that's, one of the more popular ways to earn passive income with crypto. And the video uses Ethereum as an example.
Yeah.
So can you explain exactly how staking works?
Sure. So staking is basically locking up your crypto to help secure a network.
Right.
And then in return, you earn rewards for doing that.
So you're kind of like contributing to the security.
Yeah, you're like a participant in the consensus mechanism of the network.
Okay, got it.
The concept itself is actually fairly straightforward, but
Yeah.
the execution can get a little complex.
Okay.
Like, for example, if you wanted to become a validator on the Ethereum network and get those full staking rewards,
Uh-huh.
you need to stake at least 32 ETH.
Okay, so what if I don't have 32 ETH just lying around?
Right.
Are there other ways to get involved with staking?
Absolutely. Yeah, there are services offered by centralized exchanges.
Okay.
And even some mobile wallets
Okay.
that allow you to basically stake your ETH without having to run your own validator.
Gotcha.
They basically pool together ETH from multiple users to meet those minimum requirements.
So I can still earn those staking rewards without having to like manage the technical side of things.
Exactly, yeah.
Okay, so that sounds pretty convenient, but I'm guessing there are some downsides to that as well.
There are definitely some trade-offs.
Okay, like what?
Well, one major concern is centralization.
Okay.
When you stake with an exchange, you're essentially trusting them with your ETH. Right.
So, if that exchange gets hacked or experiences any kind of issues,
Yeah.
your staked ETH could be at risk.
Okay, so it's kind of like introducing a middleman again, which kind of goes against the whole crypto ethos, right?
It does, yeah. And if too much ETH is staked with just like a handful of large exchanges, it kind of increases the overall centralization of the Ethereum network as a whole.
Right, right.
And, that goes against that whole ethos of decentralization that we love about crypto.
Makes sense.
The Ethereum Foundation, actually, they've even warned about this, stating that, these centralized staking providers can create what they call a large centralized target,
Yo, okay.
which basically makes the network more vulnerable to attacks.
So convenience does come at a price, huh?
It does. It always does.
So it sounds like, yeah, while staking through exchanges might seem like the easiest option, it's important to consider those risks
Yes.
and potentially explore other options as well.
Right. And that kind of leads us into another type of staking.
That's gaining popularity.
Oh, okay. I'm intrigued. What is that?
It's called liquid staking.
Liquid staking. Okay.
Yeah.
So what's the story there? How's that different?
Liquid staking is kind of like having your cake and eating it too.
Okay.
It lets you earn those staking rewards, but you still have access to your assets for other transactions.
Wait, so I can earn interest and use my crypto at the same time?
Got it.
Okay. How does that work?
It's done through what are called liquid staking tokens.
Right.
Platforms like Lido allow you to stake your crypto,
Uh-huh.
and then you receive a tokenized representation of your staked asset.
Okay.
So, for example, when you stake ETH on Lido, you get Steth.
Stiff.
It's a token that's pegged 1-to-1 to ETH.
Okay.
And that Steth can be traded or used in other DeFi protocols, just like regular ETH.
So it's kind of like a receipt for my stake ETH that also happens to be a tradable asset.
Exactly.
That's pretty cool.
Yeah, and these liquid staking tokens have become a pretty big part of the DeFi ecosystem.
In fact, Lido actually currently holds over 28% of the staked ETH market.
Wow, so they have a lot of power. That's kind of concerning.
It is. It's a lot of influence for sure.
Yeah.
But they have taken some steps to try to address this.
Okay.
Instead of running their own validator nodes, they actually distribute stake ETH across multiple independent node operators.
Okay.
So that way, no single operator controls more than 5% of Lido's stake ETH, or more than 2% of all Ethereum validators.
So they're spreading it out to kind of mitigate that risk of centralization.
Exactly.
Okay, that's a good approach, I think.
Yeah, it seems to be a pretty smart way to kind of deal with some of those centralization risks.
But I'm sure there are still other risks with liquid staking.
No,
though.
of course, yeah. I mean, nothing's ever completely risk-free in the crypto world.
True.
I'd say smart contract risk is a major one.
Okay.
We got to remember that all of this is built on smart contracts.
Right. And any vulnerability in Lido's smart contracts could potentially impact the entire Ethereum ecosystem.
Yeah.
Especially considering how much of the market share they have.
Right. Yeah, that's a sobering thought.
It is.
Okay, so even though liquid staking gives you more flexibility, it's super important to choose platforms with good security measures.
Absolutely.
And understand those potential risks.
Yeah, always.
Speaking of risks, I'm a little nervous to even ask about this next concept.
Okay.
Restaking.
Restaking, yeah.
What is that?
So restaking is basically staking on top of staking.
Okay.
You take those liquid staking tokens, like the Steth we were talking about, and you stake those again in other DeFi protocols to try to earn even more yield.
Whoa, okay. So I can earn interest on my staked ETH and then earn interest on that interest.
Exactly.
Is that safe? That sounds like it's getting pretty risky at this point.
It can be. It definitely can be. The more layers you add, the more complex and potentially risky it gets. You're interacting with multiple smart contracts,
Right.
each with their own, potential vulnerabilities.
Right.
So you are multiplying your exposure to that smart contract risk every time you add another layer of restaking.
So it's kind of like a high-stakes game of Jenga at that point.
But it is, yeah.
One wrong move and the whole tower could come crashing down.
Exactly.
So I'm sensing that restaking is probably not the best option for someone just dipping their toes into this crypto passive income world.
Yeah, I'd say that's probably a fair assessment.
Sure.
It is a high-risk, high-reward strategy. You could potentially earn a lot more.
Right.
But the chances of something going wrong also increase significantly.
Yeah, okay, that makes sense.
Yeah.
So what would you say is a more beginner-friendly way to explore DeFi and its earning potential?
Well, a popular option is liquidity providing,
Okay.
often called LPing.
LPing.
Yeah, it's a core mechanism of a lot of decentralized exchanges, and it allows basically anyone to earn fees
Okay.
by providing liquidity to trading pools.
So instead of just holding my crypto, I could contribute it to this pool.
Right.
And then earn a share of the trading fees that are generated by that pool.
Exactly. Yeah. And if you choose a pool with high trading volume,
Mm-hmm.
those returns can be quite attractive.
Okay. But of course, there are risks involved.
Of course, there are always risks.
Starting to see a pattern here.
Yeah.
So what are the main risks I should be aware of with liquidity providing?
Well, one of the biggest ones is something called impermanent loss.
Okay.
And this basically refers to a potential loss
Right.
that can occur because of fluctuations in the prices of the assets that you've contributed to the liquidity pool.
So even if the pool is generating these fees, I can still end up losing money if the prices of the assets in that pool move in the wrong direction.
That's right. Yeah, that's the risk. And, the amount of impermanent loss you might experience really depends on the correlation between the assets in the pool.
Okay.
If the prices of those assets move in opposite directions, the impermanent loss can be pretty substantial.
Okay, so how can I, mitigate that risk?
Well, one strategy is to carefully choose liquidity pools with assets that are known to be pretty closely correlated,
Okay.
like stablecoins or a pair like ETH and Steph.
Okay.
These pairs tend to move more together, which minimizes that potential for impermanent loss.
Gotcha. So choose wisely.
Exactly.
Yeah.
Yeah.
Okay, so liquidity providing can be a great way to earn passive income, but got to understand that impermanent loss and choose those pools wisely.
Absolutely.
Speaking of stablecoins, are there ways to earn yield specifically on those types of crypto assets?
Yeah, absolutely.
Okay.
DeFi lending is a pretty popular option for earning yield on cryptocurrencies that don't have those staking mechanisms,
Okay.
including stablecoins.
Okay, so DeFi lending, I've heard that term thrown around, but how does that actually work?
It's surprisingly straightforward.
Okay.
You basically lend out your crypto through a DeFi protocol,
Mm-hmm.
and you earn interest on that loan, just like a traditional bank,
Right.
but without the bank.
Right, without the middleman.
Exactly.
Yeah.
A HAV is a popular and pretty reputable protocol for DeFi lending.
Mm-hmm.
They're currently offering a supply APY of around 3.8% for stablecoins like USDC.
Okay, so not life-changing returns, but better than, what most traditional banks are offering.
Oh, for sure.
Yeah.
Okay, significantly better.
So are there any other options for DeFi lending, especially if, maybe I'm looking for slightly higher returns?
Yeah, there are. The video actually highlights real-world asset protocols as a potentially compelling alternative.
Oh, interesting. Real-world assets, so is that like earning yield on crypto that's backed by like real estate or commodities or something like that?
Not quite, at least not yet.
Okay.
RWAs and DeFi are still relatively new
Okay.
and mostly limited to kind of more traditional assets like bonds.
Gotcha.
One example is the Ono protocol and their tokenized U.S. government bond, USDY.
USDY, okay. So that's a crypto token that basically represents ownership of a U.S. government bond.
Exactly. Yeah.
Okay, that's interesting.
Yeah, and what's kind of interesting is that USDY is currently offering a pretty decent APY of around 5.35%.
Okay.
Plus, its price has actually been appreciating as well.
Oh, wow. Okay, so that's pretty impressive.
Yeah, it is.
So what's driving that yield and price appreciation?
Well, the yield comes directly from the interest payments on the underlying U.S. government bond.
Okay.
So, it's considered a pretty safe yield in the crypto world,
Uh-huh.
backed by the U.S. government.
Right. So it's a little less volatile than, some of these other crypto assets that are, fluctuating wildly.
Exactly.
Okay, that's a good compelling argument.
Yeah.
So, if I'm looking for kind of a stable and potentially less risky way to earn passive income,
Mm-hmm.
these RWA protocols like Ono could be worth checking out.
Yeah, definitely.
But to be honest, all this talk about DeFi and smart contracts, it's making my head spin a little.
I get it. DeFi can definitely have a steep learning curve.
It can.
Yeah, there's a lot to wrap your head around.
There is.
But luckily, centralized exchanges have kind of recognized this demand
Mhm.
for more user-friendly passive income products.
Okay.
And they've really stepped up their game.
Oh, okay. That's a relief.
Yeah.
I'm much more familiar with those centralized exchanges.
Right.
So what kind of passive income products are they offering these days?
Well, the video mentions Bybit as an example.
Okay, Bybit. I've heard of Bybit.
Yeah, so they offer a few different products,
Yeah.
Including Bybit savings, dual asset,
Okay.
and liquidity mining.
Okay, so let's break those down. What is Bybit Savings?
Right. So despite the name, Bybit Savings is actually more about lending than traditional staking.
Okay,
Essentially, you're lending your crypto to other traders on Bybit in exchange for interest.
gotcha.
And they offer both flexible terms where you can, withdraw your assets anytime,
Ah.
and fixed term loans, which usually come with a slightly higher yield.
Okay, so it's kind of similar to DeFi lending, but through a centralized platform.
Exactly. Yeah.
Okay, what about dual asset? The video mentioned high returns, but also high risk.
Yeah, so dual asset is basically crypto options trading kind of disguised as a passive income product.
Oh, okay.
Um, and options are complex financial derivatives
Okay.
that give you the right, but not the obligation, to buy or sell an asset at a predetermined price in the future.
Options trading, I'm already lost here.
Yeah, it can be pretty complicated.
Okay, so maybe not the best option for someone just starting out.
Probably not, no.
Okay, duly noted.
Options trading can be it can be very risky,
Ah.
and it requires a pretty deep understanding of how it works.
Okay, I'll steer clear of that one for now.
Probably a good idea.
What about liquidity mining? That one sounds a little familiar.
Yeah, you're right.
Yeah.
Liquidity mining on Bybit is basically liquidity providing, just like we were talking about in DeFi.
Okay.
You provide liquidity to a trading pair
Uh-huh.
and earn a share of the trading fees.
So basically LPing, but rebranded
Mm.
for a centralized exchange.
Exactly.
Okay.
Yep.
Do they offer similar returns and risks as like the DeFi version?
Yeah, the potential returns can be pretty attractive.
Yeah.
And they even offer the ability to leverage your position to kind of amplify those gains.
Okay.
However, that leverage also amplifies your losses
Right, of course.
and can lead to something called liquidation if the market moves against you.
Okay, so high risk, high reward. Got it.
Yeah, for sure.
Okay, so it seems like centralized exchanges are kind of trying to offer like a taste of DeFi
They are.
with these products,
Yeah. Yep.
but with a more user-friendly interface.
Right. Exactly.
Which I appreciate.
Yeah.
But it's important to remember that, like, those underlying risks are still there,
They are.
whether you're using a decentralized or a centralized platform.
Absolutely.
Right. Okay.
Yeah.
Well, this is certainly a lot to process.
It is.
It seems like there are so many ways to generate passive income
Mhm.
with crypto,
There are?
but understanding the risks involved is, like, crucial.
Absolutely.
And it's clear that DeFi, while it could be very lucrative, it comes with a very steep learning curve.
Yeah, it definitely does.
Maybe we should, like, stick with the basics for now.
Yeah, that's probably a good idea.
Okay.
Why don't we shift gears a little bit
Okay.
and explore a more traditional approach to crypto passive income?
All right. I'm game. What is it?
Mining?
Mine.
Okay, perfect. Yeah, mining. It's the OG way to earn some passive income in the crypto world.
Right.
Using your computer's power to solve those tricky math problems and help secure the blockchain.
Yeah, but isn't mining only for, like, the super techie people with those massive, expensive mining rigs?
That used to be the case, especially in those early Bitcoin days.
Yeah.
But things have changed. You don't need a basement full of ASIC miners to get in on the action these days.
So what are these easier ways to mine that you're talking about? I'm curious.
One option that's become pretty popular is cloud mining. Instead of investing in all that expensive hardware and dealing with the technical headaches of setting up and running your own mining operation, you just rent computing power from a cloud mining provider.
Oh, interesting. So it's like outsourcing the whole mining process to someone else.
That's the gist of it.
Yeah.
You pay a fee, and they handle all the hard stuff, the hardware, the electricity, the maintenance, the whole 9 yards. You just sit back, relax, and collect your share of the mining rewards based on how much computing power you've rented.
That sounds a lot less intimidating than running my own mining farm. But I'm sure there are some downsides to cloud mining, right? No free lunch and all that.
Of course, there are always trade-offs. One risk to be aware of is scams. There have been a lot of shady cloud mining operations out there that promise unrealistic returns and then vanish into thin air with people's money.
Yikes. So I guess it's really important to do your research and choose a cloud mining provider that has a solid reputation and track record.
Yeah, absolutely. Due diligence is key. Another thing to keep in mind is the volatility of mining profitability. The amount of profit you can make from mining depends on a bunch of factors. The price of the cryptocurrency, the difficulty of the mining algorithm, the cost of electricity. All these things can fluctuate a lot, which makes it tough to predict how much you'll actually earn.
So even though cloud mining sounds pretty passive, It still requires some monitoring and maybe some adjustments to make sure I'm actually getting a decent return on my investment.
You got it. It's not completely hands-off. And speaking of monitoring and managing your crypto, let's switch gears for a minute and talk about another interesting option, masternodes.
Masternodes. I've heard that term before, but I'm not really sure what they are.
Okay, so basically masternodes are like specialized nodes on a blockchain network that do more than just validating transactions. They might be responsible for things like instant transactions, enhanced privacy features, or even voting on governance proposals.
So they're like the VIP nodes, providing extra services and helping the blockchain run smoothly and securely.
Exactly. And because they're doing all this extra work, masternode operators get rewarded with a portion of the block rewards.
That makes sense. But I'm assuming there are some hoops to jump through to run a masternode, right? It can't be that simple.
You're right. There are usually some requirements. The main one is that you typically need to hold a specific amount of the cryptocurrency that's associated with the blockchain you want to support. This can be anywhere from a few $100 worth of coins to tens of thousands, depending on the specific blockchain.
Okay, so it's a bigger investment than, say, cloud mining or staking a small amount of crypto.
It can be. But the potential rewards can also be higher. Masternodes often provide a more stable and predictable income stream compared to some other passive income methods.
There's always a trade-off, right? But what about the downsides? Are there any risks involved with running a masternode?
Of course, nothing's completely risk-free. One thing to consider is that running a masternode requires a certain level of technical expertise. You need to be able to set up and maintain a server, make sure it's online 24/7, and keep it secure. You'll also need to keep up with any software updates.
So it's not exactly a set it and forget it kind of thing.
Not really. You need to be comfortable with the technical side of things. And just like with cloud mining, there's always the risk of scams. Some projects might advertise masternodes with crazy high rewards that are too good to be true and then disappear with your funds.
So research is key again. I need to thoroughly vet any project offering masternodes and make sure they have a solid team, a clear plan, and a history of actually delivering what they promise.
Exactly. Always do your due diligence. Speaking of potentially lucrative opportunities, let's shift gears again and talk about something a little different, airdrops.
Oh yeah, airdrops. I've heard about those. They're basically free crypto giveaways, right? Who doesn't love free crypto?
They can be, but it's not always as easy as just signing up and receiving a bunch of free tokens. Airdrops are often used by new cryptocurrency projects as a way to distribute their tokens to a wider audience and create some initial buzz and interest.
So how do you actually qualify for an airdrop? What do you have to do?
It really depends on the project. Some airdrops might just require you to hold a certain amount of another cryptocurrency like Bitcoin or Ethereum. Others might have you complete certain tasks like following the project on social media, joining their Telegram group, or filling out a survey.
So it's not exactly free money, but it could be a way to snag some extra crypto for putting in a bit of effort.
Yeah, that's the idea. And sometimes airdrops can be pretty lucrative. If you happen to get in early on a project that ends up being successful, the value of those airdrop tokens could increase significantly.
That would be awesome. But I'm guessing there are also some potential downsides and risks associated with airdrops.
You guessed it. One of the biggest risks is scams. Unfortunately, there are a lot of fake airdrops out there designed to steal your personal information or even your crypto.
So how can I tell the difference between a legitimate airdrop and a scam?
That's a great question.
Yeah.
Always, always, always do your research before participating in any airdrop. Check out the project's website, read their white paper, look for reviews and discussions about them on reputable crypto forums. Be very wary of any airdrops that ask for your private keys or tell you that you need to send them crypto to receive the airdrop tokens.
Those are definitely big red flags. So airdrops can be a fun and potentially profitable way to add to your crypto holdings. But I need to stay vigilant and avoid anything that seems too good to be true.
Exactly. Trust your instincts and always err on the side of caution. And speaking of things that might seem too good to be true, let's talk about another popular way to potentially earn passive income with crypto yield farming.
Yield farming. Okay, that one sounds a little intense. Even the name is kind of intimidating. What exactly is yield farming?
So yield farming, sometimes called liquidity mining, is basically a way to try to maximize your returns by strategically moving your crypto assets between different DeFi protocols.
So you're actively chasing the highest yields across various platforms. That sounds like a lot of work.
It definitely can be. Yield farmers are constantly searching for the best opportunities to earn interest fees and rewards by lending, borrowing, staking, and providing liquidity on different DeFi platforms.
So it sounds like yield farming requires a lot of research, constantly monitoring the market, and actively managing your assets. It's not exactly passive, is it?
You're right. It's definitely not a set it and forget it strategy. It's more like active trading within the DeFi ecosystem, and it's not something I'd recommend for beginners.
What about the risks? What are some of the main risks involved with yield farming?
All the risks we've talked about today apply to yield farming, but they can be even more pronounced. You've got smart contract, risk impermanent loss rug pulls. It's a high risk environment.
Rug pulls. What are those?
A rug pull is basically when the developers of a DeFi project abandon the project and run off with everyone's money. It's an exit scam.
That sounds terrifying. So yield farming is definitely a high-risk, high-reward strategy that requires a lot of knowledge and time and effort to do it.
Exactly. It's not something to jump into lightly.
Yeah.
Okay, I think we've covered a lot of ground here. We've gone from the OG mining to the wild world of DeFi and yield farming. It's a lot to digest.
It is. Feels like there's just so many options, each with its own set of pros and cons. It's kind of overwhelming trying to figure out where to start.
I hear you. It can definitely be confusing, especially with all the new platforms and strategies popping up all the time. I think it's time to zoom out a bit and focus on the bigger picture.
That sounds like a good plan. Maybe we can offer some key takeaways to help our listeners figure out what to do next.
Definitely. After a short break, we'll wrap up this deep dive with some final thoughts on how to navigate the world of crypto passive income and make smart decisions based on your own personal situation. Stay tuned.
Welcome back to the Deep Dive. Phew, we covered a lot of ground in this episode, from the crazy world of DeFi and yield farming to the more, I guess you could say, traditional methods like mining and master nodes. It's clear there are tons of ways to try and put your crypto to work, but man, it's a lot to wrap your head around.
It really is. There's always something new popping up in the crypto world. New protocols, platforms, strategies. It can be exciting, but also pretty overwhelming, especially for, anyone who's just starting out.
Exactly. So let's try to break it down a bit. If someone is just beginning their crypto passive income journey, what would you say is the best place to start?
I think the most important thing is education. Really take the time to learn the basics, understand how blockchain technology works, the different types of crypto out there, and the risks involved with each investment approach.
Yeah, it's tempting to jump into whatever's hot at the moment, right? You see a flashy ad or hear someone on social media hyping up the next big thing, and you just want to dive in head first.
It's easy to get caught up in the hype, but that's how people get burned. Do your own research, read white papers, follow reputable crypto news sources, and maybe even find some online communities where you can connect with more experienced investors and learn from them.
Yeah, finding a good community can be super helpful.
Mm.
And actually, the video we've been using for this deep dive also stressed the importance of comparing potential returns with Bitcoin's compound annual growth rate.
Oh, that's a really good point. Bitcoin has this proven track record of growth, and its long-term performance can be a useful benchmark when you're trying to figure out if another strategy is actually worthwhile.
So before I go chasing those crazy high yields on some, risky altcoin or get lost in the weeds of a super complex DeFi strategy, it's smart to step back and ask myself, would this actually be better than just buying and holding Bitcoin?
Exactly. There's no guarantee that anything will outperform Bitcoin in the long run. It's about making informed decisions and understanding the potential trade-offs.
Right, right. And something else that really stuck with me from our conversation was the importance of diversification.
Absolutely. Don't put all your eggs in one basket, as the saying goes. Spread your investments across different assets, platforms, and strategies. That way, if one investment doesn't work out, you're not risking your entire portfolio.
It's like that old saying, don't bet the farm on one horse. Makes sense to me.
Yeah.
And even though we've been talking about passive income, it's not totally effortless, right?
Definitely not. Even the most hands-off strategies still require some level of monitoring adjustments and management to make sure you're maximizing your returns and minimizing those risks.
So it's about finding that balance between how much effort you're willing to put in and the potential reward.
Right.
And also choosing strategies that match your own personal goals and risk tolerance.
Exactly. Some people are comfortable with higher risk if it means a chance at bigger returns. Others might prefer a slower, steadier approach with less risk. It's all about finding what works best for you.
Yeah, finding your own crypto groove. And one last thing to remember is this is a long game. Don't expect to get rich quick. Crypto passive income is about building wealth gradually over time and also playing a part in growing that decentralized economy.
Couldn't have said it better myself. It's a
Yeah.
really exciting time to be in this space, and the potential is huge. Just remember to stay informed, be cautious, and never stop learning.
Those are wise words. So, as we wrap up this deep dive, what's one final thought you would leave our listeners with?
I would say Don't just chase yields, chase knowledge. The more you learn and understand about this space, the better equipped you'll be to make smart choices and navigate all the ups and downs of the crypto world.
That's fantastic advice. Well, thanks for joining us on the deep dive today. We hope this has been helpful and inspired you to explore the possibilities of crypto passive income. But remember, always do your own research and never invest more than you can afford to lose. Until next time, happy investing, everyone.